He did everything right. 62 years old, $1 million sitting in his IRA. 3 years of Roth conversions, every year, on schedule, doing exactly what the financial magazines told him to do. Paying taxes up front, building his tax-free future. Then he sat down and ran the real numbers, not headline numbers, the actual lifetime impact. What he found stopped him cold. He had been converting wrong. One factor, one miscalculation, the cost, over $1 million in lost tax-free wealth. Quietly drained by a mistake most advisors never flag and most retirees never see coming. The freight tax train doesn't wait for 73. It can hit years earlier, silently, while you believe you're protected. I'm James Caldwell, and today I'm going to show you exactly what that trap is, who falls into it, and what you can do right now, while the window is still open. Let's start with the basics, because the basics contain the trap. A Roth conversion is when you take money from a traditional IRA or 401k, money the IRS has never taxed, and move it into a Roth IRA. You pay taxes on the amount you convert in the year you convert it. In exchange, that money grows tax-free forever. You never pay taxes on it again. For someone with $500,000 or more sitting in a tax-deferred account, that distinction is the difference between control and obligation in retirement, a protected tax-free container the IRS cannot touch. The trap. Nobody warns you about timing. Here is where most people go wrong. The conventional wisdom is, wait until you retire. Your income drops, your bracket drops, and you have the golden window for conversions. The gap between your last paycheck and the day your RMDs force taxable income back onto your return. Logical. But here is what that thinking misses entirely. If you have $500,000 or more in a tax-deferred account, are still working, and spend less than you earn, your conversion window may be open right now. Wait for the retirement window and you arrive with less room, Social Security stacking your brackets, and fewer compounding years left. Let me show you what I mean. Phil and Carol, both 60, still working, solid incomes in Ohio, $1 million in their 401ks, spending less than they earn. The bracket math that changes everything. Phil and Carol file jointly. Their combined income fits inside the 24% tax bracket, but not at the top. There is empty bracket space above them going to waste every year. A smart Roth conversion fills that bracket space deliberately, not recklessly into the 32%. Surgically to the top of the 24%, not a dollar more. Taxes paid from cash flow outside the IRA, not from the account. Pay from outside the account. Every converted dollar goes into the Roth and compounds. Pay from inside the IRA, you are not converting what you think. A $180,000 conversion with $43,000 withheld puts only $137,000 in the Roth. You lost $43,000 of compounding before day one. Phil and Carol convert $180,000 per year. $43,000 in taxes paid from surplus cash flow. Every dollar goes into the Roth. 5 years before retirement. Lifetime tax-adjusted benefit, over $2 million. Wait until after retirement. Same brackets, same conversion amounts, under $400,000 in benefit. Same strategy, different timing, $1.6 million difference. That is the trap. The 3 factors that make or break every Roth conversion. Factor 1. Investment selection inside the Roth. The conversion only works if what goes inside actually grows. Convert into a money market earning nothing, and you paid taxes for almost nothing back. Convert into a properly structured indexed universal life policy under IRC Section 7702, and the tax-free compounding becomes extraordinary over decades. A properly structured 7702 policy works like this. If the market goes up, you make more money. If the market goes down, you do not lose any money from that. The protected tax-free container holds, regardless of volatility. That is not a sales pitch. That is the math. Factor 2. Bracket discipline. Every conversion adds to your taxable income. Precise execution is everything. Fill the space inside your current bracket, not $1 into the next. Your optimal number is specific to you. Off by 1 bracket over 10 years, 7-figure cost. Factor 3. Where the tax money comes from. This is the factor that destroyed $1 million in my client's tax-free wealth. Pay from inside the IRA, less money reaches the Roth. Pay from outside, every dollar compounds. That surplus income you are not spending is your conversion fuel. Use it. The widow's penalty and the full picture. One more dimension most advisors miss entirely. The widow's penalty. The moment your spouse passes, the IRS changes your filing status to single filer. Overnight. Same IRA balance. Same RMDs. Narrower bracket. Higher rate. Already written into the tax code. Already waiting. The cash value inside a properly structured life insurance policy is a Tier 1 asset. The same category banks use for cash and U.S. Treasury bonds. The Roth conversion and the protected tax-free container complete each other. Roth converts existing qualified money before RMDs force your hand. The container grows new capital tax-free. Together, the wall between your retirement and the IRS. How to actually start. Practical steps while you are still working. If this is you, $500,000 or more in a 401k or IRA, income you are not fully spending, ages 55 to 70, two things determine whether your window is open. First, know your bracket. How much empty space sits above your current income? A couple earning $200,000 has a very different window than one earning $350,000. That number is specific to you, not a rule of thumb. Second, pay from outside. Roth conversions funded from surplus income, money you earn but do not spend, are the most powerful. Every converted dollar stays in the Roth. Every dollar compounds. The ones funded by withholding from inside the IRA are weaker from day one. That is where windows get wasted. The window is not unlimited. At 73, required minimum distributions begin. The IRS puts income on your return whether you want it or not. Brackets fill. Medicare premiums climb, Social Security gets taxed harder. And the widow's penalty waits. The freight tax train runs on schedule. The question is not whether Roth conversions matter. They do. The question is whether you are doing them at the right time, in the right bracket, with the right money. Here is what I want you to take away. Roth conversions work. They are one of the most powerful tools available to someone with $500,000 or more in a qualified account. But they only work when the timing, the bracket, and the funding source are all aligned. Get anyone wrong, you are not building wealth. You are quietly draining it. I know what you are thinking. I should have someone run my actual numbers. You are right. It is one private conversation. Your accounts, your income, your bracket, your window. We look. We tell you exactly where you stand. Below this video is a link. Book a private, one-on-one strategy session. No group calls, no webinars. Just your numbers and your window. Rescue, reclaim, retire richer.